Bismillahirrahmanirrahim. Subject is financial statement analysis. This is 15 lecture as schedule provided in a semester system, while it is second online lecture. Today we will discuss vertical or common size analysis. Topic to be covered in this lecture are: what is vertical or common size analysis, vertical or common size analysis of income statement, vertical or common size analysis of balance sheet. So first we discuss that what is common size or vertical analysis. As in earlier lecture, this common size analysis or vertical analysis are involved that all figure of financial statement to be shown as a percentages of the total of asset in case of balance sheet, and total of asset in case of balance sheet, and total of sales in case of income statement. So in case of income statement, we will show each item or each figure of the income statement is a percentage of the total sale. So we will consider this total sale is equal to 100%. Since balance sheet have two sides, so this total assets, all the asset, either it is non-current asset or current asset, it will be each figure will be shown as a percentage of their total assets. So the total asset will be considered as 100%. On liability side, liability and equity side, each figures of liability and equity side will be shown as a percentage of that total liability. So it will be considered as 100%. Now total assets are taken as 100% in case of and different assets are expressed as a percentage of that total. Individual assets are expressed as a percentage of the total asset. 100 of different for example 100, and different liabilities are calculated in relation to total liabilities discussed earlier. Now vertical or common size analysis of the balance sheet. Here is an examples of two companies that we will discuss. As one is Anu Private Limited and other is Bansal Private Limited are given below. This is the balance sheet, although not according to the format. Preference share or share capital 120,000 and 150,000, equity share capital 140,000 and 10,000. Reserves and surplus are 24,000 and 28,000. Long-term loan are 110 and 120. I guess this is not 410, this is 1. Fine, it is 410. A long-term loan 110 and $120,000. Bills payable, short-term liability 7,000 and 1,000. Sundry creditors 12,000 and 3,000. Outstanding expenses, that is 15,000 and 6,000. Proposed dividend 10,000 and 90,000. This is basically one side of the balance sheet, liabilities and equities shareholder. Now what is the situation of the asset side? In asset, let's start from non-current asset, that is land and building, plant and machinery, temporary investment. These both investment are considered as short-term investment. Sundry debtors, prepaid expenses, cash and balances. So land is of 80,000, 120,000 for Bansal company, 334 and 600,000, 5,000 temporary investment, 40,000 temporary investment, sundry debtors 4,030, prepaid expenses 1,000 and 2,000, cash and cash balances 8,000 and 10,000. Going further, what is required? Compare the financial position of the two companies with the help of common size balance sheet. Financial position. So we will discuss on the financial position of the company. We will provide interpretation. Now, moving further, vertical analysis of balance sheet. First of all, we will start it from asset. What is the position of assets? Fixed asset, land and building, plant and machinery, total fixed asset, investment, temporary investment, sundry creditors, prepaid expenses, cash and cash balance, total current assets. That is total assets. In common size analysis, we will consider this is in 100%, which is the total. Now each figure will be expressed as a percentage of this 438. How this 18,000 have been calculated? It is like this: 80,000 divided by 438,000 multiplied by 100 will be equal to this 18.26. How this 34,000 is calculated? This 76.26 have been calculated. 334,000 divided by this total multiplied by 100 will be equal to this amount. How this percentage is calculated? Total asset, total fixed asset divided by total asset multiplied by 100 will be equal to 94.52. So each item divided by total multiplied by 100. Each figure divided by total multiplied by 100 will provide you these percentages. How this temporary investment is calculated? 5,000 divided by 438 multiplied by 100 will provide you this result. How this cash balances have been calculated? 8,000 divided by total multiplied by 100 will provide you this amount. Total current asset 24,000 divided by 438 multiplied by 100, that will provide you 5.48. Now coming to the Benson Limited, how this figure have been calculated? First of all, consider this is 100%. Now each item will be expressed as a percentage of this 808,000. Now 123,000 divided by 808 multiplied by 100. 123,000 divided by 8,000 multiplied by 100. Will provide you this 15.22. This figure 600,000 divided by 808,000 multiplied by 100 will provide you this amount. So each item have been obtained by each item individually. For example, 723,000 divided by this total multiplied by 100 will provide you this 89.48. So each item is expressed is a percentage of this total. Each item is expressed as a percentage of this total. This is the way how to calculate each figure and how to conduct this analysis. Now moving further. Now equity shares, this is total and this percentage is calculated 140,000 divided by this total multiplied by 100. Preference share percentage is calculated this 120,000 divided by 438,000 multiplied by 100. When reserve and surplus percentage have been calculated, this 24,000 divided by 438,000 multiplied by 100. So similarly, this total capital have been obtained as 284,000 divided by 438 multiplied by 100. Each item is expressed as percentage of this total. This is called common size or vertical analysis, because vertically each item is expressed in terms of this total. Now come to the interpretation. If we consider or we focus on this analysis, this Pencil Limited is traditionally financed. Traditionally financed means that it employed more of its own resources than for finances than external finances. Moving backward, let me explain it. This is 74% of their own resources they are going to finance, while long-term loan is 14% only. 12% is financed through short-term liability. While come to this company, it finances its asset or its operation from 64% from its own capital, while employing 25% external financing in longer term, while in short term spontaneous financing is 10%. So it will have more tax benefit than this company. In longer term, it will produce better cash flow in response to its total investment in the asset, and it will provide good return on assets. Both companies are suffering from shortage of working capital. Only 12% or 14% of the total liability is working capital. So this working capital should be increased. The percentage of current liability is more than the percentage of the current assets. So they invested less in their current asset, which may give them disadvantage over their competitors if shortage or infrastructure or some riots or some political instability occur in the country. Now we are moving to vertical analysis of the income statement. Again, we will consider an example here that in order to discuss the vertical analysis of income statement. Vertical analysis and common size analysis are one and same thing. Following are the income statement of the company for the year ending 31st December 2006 and 2007. We have been provided with the sales, that is 500,000, miscellaneous income 20,000, while 700,000 sales in 2007. Miscellaneous income decrease. Total revenue is 20,000, 2006, 715, that increases. Cost of goods sold increases in absolute terms. Office expenses increases in absolute terms. Interest increases in absolute terms. Selling expense increases in absolute terms. Total expenses increase in absolute terms. Our net profit have been decreases. This is, let's suppose, any of the company XY Z company. A vertical analysis of the income statement. Now, this is the vertical or common size analysis. We will consider this 100 sales 100%, and then we will express each item as a percentage of this one or total of the income statement. So we will consider this is 100% or the total. Each item have been expressed in this analysis is a percentage of this total. So how we get this 66%? Here is 330,000 divided by 500,000 multiplied by 100. We will repeat this same for all items. So all these calculations have been in the same way. This 34% is 170 divided by 500 multiplied by 100. This is obtained through 20,000 divided by 500 multiplied by 100. So in this case we consider this is total for income statement. It will get a value of 100%, and then we will express each item as a percentage of this total. Gross profit is 66%, 34%, office expenses 4%, selling expenses 6%, total operating expenses 10%, operating income 24%, miscellaneous income 4%, total income 28%, interest is 5%, now net profit is 23%. Coming to this position, that is 72.86%, 27%, 4.9%, office expenses 5.7%, 17.14%, miscellaneous income, and total income, interest expenses. Now coming to the positions that although in absolute term the sale have been increases, but our gross profit percentage increases. It is 66% and 34%, now it is 27%. Gross profit have been decreased in percentage. This disturbance may occur due to two reasons. Maybe the 700,000 sale is increased due to discount on each item. It may be due to discount. In case of discount, we increase our sale in absolute terms, but each item carry the same amount of cost of goods sold. So cost of goods sold increase the percentage of the total sales because it remain constant per item while we are selling our item at discounted prices. So sale in absolute term increases, but this proportion or this ratio combination have been disturbed. Other reason is maybe the sale is on their market prices and we cannot afford any discounted. The company cannot afford discount, but due to overhead charges, the cost of goods sold may increases. For example, repair and maintenance in the company in the machinery, high labor cost due to inflations, other items may be increased due to inflation, and we are in competitive industry and we cannot increase our prices. So in this case, the cost of goods sold may increases due to overhead charges. Now come here that although these office expenses, selling expenses have been reduced. That should be checked in combination with the total sale. Means the company may reduce its advertising expenses and offer discount to the customers. That's why these have been decrease in with reference to the total sales. Operating income decrease due to this cost of goods sold increases. Total income, interest means in the same financial position or in the same financial structure the company increase its sales, and these things are constant. So this is the interpretation of the vertical analysis of the interest. Sale and gross profit have been increased in absolute terms. In 2000 as compared to 2006, but percentage of gross profit sale has gone down. Net profit have decreased both in absolute figure is a percentage in total in 2010 as compared to 2006. Sale may increase due to discount prices per item, piece or unit, while cost of sale remain the same. The cost of sale may increase due to extra overhead charges, and the industry is competitive, may not increase its prices. This is all about vertical analysis. Thank you.